Investing in the stock market can generate huge growth in your retirement account, but you need to be aware that it's also full of risks. Did you know that a share of Google, which sold for $506 in 2011, could have been bought in 2004 for about $100? Apple, selling at $336 mid-year in 2011, could have been bought for $3.02 in 1984. And what about Microsoft? Selling at $26 on June 30, 2011, Microsoft could have been bought, adjusted for stock splits, in 1986 for 8 cents. Make a few investments like these in your 401k and you could retire early. But don't give your notice quite yet. For every technology company that made it big, there are a dozen that failed, and the risks don't stay with just technology companies. How about Enron, one of the nation's largest energy companies, at one time? Its stock went from $90 in August 2000 to under $1 in 15 months. Ford Motor, its value has been cut in half over the last 10 years. How about Chrysler or AIG, Bear Stearns? The possibility of losing lots of money by investing in stocks is what we refer to as market risk. Investing in a stock can also involve another form of risk, company-specific risk. You may have thought correctly that it was time to invest in technology stocks, but you picked a company whose operations, or product, or business environment caused it to underperform other companies in the same industry. Its business failures and poor stock valuations had nothing to do with the overall economy. Foolishly, some people have invested a very large percentage of their portfolio in just one or two companies that failed spectacularly. Obviously, they never took to heart the general principle of never putting all of your eggs in one basket. Well-diversified stock portfolios avoid company-specific risk, and long-term, they can reward you for the market risk you take. Diversification means that you own a wide range of different types of stocks, easily categorized as companies here in the US or overseas, and by capitalization, meaning how big they are. Unless you have the expertise to undertake the research into individual stocks, we suggest you invest within a mutual fund. Mutual funds offer you the opportunity to diversify your portfolio and minimize company-specific risk. Keep in mind a few facts about investing in stocks. It should not be a surprise to you that the stock markets go down as well as up in value. The surprise is when stocks go down, and by how much. Don't panic when the market goes down. You make money in the stock market because of the risk, not despite the risk. Some stock investments will do better than others, but performance will often zig and zag. It's impossible to always know with certainty in advance which stocks will perform better than others. We think the secret to investment success does not require you to know in advance when the market goes up and down. Success comes from owning a well-diversified portfolio, one whose risk is right for you and your circumstances, and one that you can own long-term through the inevitable ups and downs of the financial markets.